Good morning, ladies and gentlemen. Today is time for that time of the week again for the weekend deep dive. So we're going to get started with the heat map review quickly, and then we're going to head into the news of the week. Afterwards, we're going to jump into biggest winners and losers. So as you can see for the heat map, it's pretty much a blood red week. There was little to no green on the week performance for stocks. If mainly you noticed Nvidia being green on the week just because it had a massive earnings. But even though it is massive earnings, it only finished 7% up. However, overall, just a bloodbath on the S&P 500 and NASDAQ. This is the combination of all the stocks. So let's take a look at what may have caused this. So if we dive into the week's news, February the 20th was a holiday, so there's no trading then. Tuesday, we started off with manufacturing PMI, services PMI, which came in a little bit better than expected, meaning that the economy was going through expansion. Services PMI basically means higher cost of goods, which is in line with the last week's PPI report that came in hotter than expected. So you're seeing services, cost of services go up. Bearish for the market because it incentivizes the Fed's rate hikes that they're not finished. This actually surprised me that it moved the market slightly because they were seeing like a shrinkage in the economy, mortgage applications coming in significantly lower. So basically you're seeing that demand destruction that we've been talking about. And then the big daddy news came in, FOMC meeting minutes. If you guys haven't seen the midweek update, I highly recommend go watching it and going to the Fed minutes section. We did go over what was in the Fed minutes. Too long didn't read version is with good data that the Fed was seeing, because this is the minutes prior to all the CPI, PPI, and PCE this week. This is their perception of the market at that time. And if I told you this was the February meeting or March meeting, you would have believed me because it sounded like a hawkish rhetoric. I could barely find any dovish rhetoric in there. They were just hammering the hawkish tones and basically saying there's more to do. You had Williams then come out and basically reaffirm the FOMC minutes, not really changing the tone on the market. However, the market on Thursday was stubbornly still trying to push higher. We're going to talk about that as well. You had the GDP revision that came in as a shrinkage, which is actually in line with the Federal Reserve summary of economic projections. They're showing this quarter and next quarter to start to shrink. So now it's heading towards, economists that have been doing this for forever are kind of seeing and saying. You had continuous jobless claims again come in better than expected. It's almost like these people are trying to make this number come in and seem better than expected because it always gets too high. Like, you guys know my spiel about the 200K guess. It's always coming in wrong. I said 195, I got 192, so pretty close on that one. Strong labor market increasing the ability for people to buy because their wages are going up. You had FOMC Bostic, a member speaking, which again, she's not a voting member, so it really didn't matter. And next we go to Friday's Grim Reaper. I think Fridays are becoming Grim Reaper news because I thought PPI would have topped it. Core PCE and PCE came in blazing hot, red hot, iron hot, stick your hand on a blazing stove hot. Whatever analogy you want to throw at it. Core PC was expected to come in at 0.4, flat from last month. It came in at 0.6. The last month's got revised upwards to 0.4. So not only did you have a beats on expectations, the previous one got revised higher. Core PC index year over year got revised from 4.4 to 4.6 last month, came in at 4.7. So not only did you fail to drop significantly last month, you actually went up from that reading that got revised higher. So double whammy there. Then regular PCE came in at a 5.3 and 5.4, revised 5.3 and then 5.4, ticking up 0.1% from last month's reading that was revised higher. Core PC month over month, I think this one was the most murderous of them all. 0.2 revision last month and then tripled the number to 0.6 with their expectation of 0.5. So this is basically saying inflation is alive and well, and it is chugging along. And similar to how Bull Alert was saying that inflation is going to stay persistent, and how a lot of the members saying that inflation is not vanquished yet, but they still were playing those dovish tones, I wonder what they're going to say now after seeing their preferred metric. This is the Fed's preferred metric. They state their targets for this metric in their summary of economic projections, which is what the Federal Reserve uses to determine what their next actions are going to be. And link it down in the description below, guys. We're going to link the summary of economic projections. We also had Jefferson speaking. I didn't actually get a chance to look at what he said, and then Messer, which isn't a voting member. So overall, this news cemented the market. And when this news came out, all you saw was a straight elevator down. Case in point, the heat map, you just had bad news on bad news on bad news. So we're going to jump over to the sector review to give you the biggest winners and losers. Hopefully there's some winners in there because this week has been an absolute tear.
So now, guys, let's actually come over here and check out what Boy just said. Well, let's take a look at, first of all, the S&P 500 index. You can see on the 5-day, it was down, though it didn't end as low as I would think. On the 5-day, it only came down 1.81%. And, well, as of Friday, it was a lot lower, but it still ended the day on negative 1.05%. So you can tell that, we're probably going to see a lot of red. I mean, you guys probably just saw it. So yeah, let's actually now delve into the S&P 500 heat map to see, well, which are the biggest losers and which are the biggest winners. And it's, as Boy just said, it's a bloodbath out there. So let's start off, guys, with the tech sector. Normally I would have a hard time telling you guys which ones are the biggest gainers, but now it's the opposite. The biggest gainer when it came to the technology sector was actually a company in the software application that I've never heard of before, ANSS, gaining 6.62%. Of course, I also have to shout out Nvidia because out of all the semiconductors, that was the only company that gained. All other semiconductors collapsed massively. Nvidia was the only one that gained 5.84%. Other companies like Oracle, Synopsys, all of them gained, but again, the biggest gainer was none other than ANSS, which gained 6.62%. And in regards to the biggest loser in the technology sector, it was none other than a company called Keys. And if we actually come over here, it lost, guys, 15.6%. And as you guys can see, there was a lot of red pretty much everywhere. But again, that one was the biggest loser at 15.6%. And overall, the technology sector, guys, lost on the week 5.66% here on the XLK ETF. Coming down into the communications sector, a lot of red here too. In fact, there was only one that was actually in the positive, and that was none other than Warner Bros. Guys, if you guys haven't checked out my Warner Bros stock analysis and even earnings report video on it, make sure to check it out because, well, I actually said that this company should fall a little bit more. So, the fact that it gained 1.57%, again, if you guys don't know what their fundamentals look like, you really need to take a look because they just finished an acquisition with Warner Bros. As well as the whole HBO brand from AT&T. So their fundamentals aren't looking too good right now, but nonetheless, they still gained 1.57% on the week. And the biggest loser would be none other than Live Nation Entertainment, losing 12.06%. And when it comes to the XLC ETF, you can see that this one on the 5-day lost around 3.04%. Looking now into the consumer cyclicals, guys, there's only one green company in this whole entire thing, and it's like Finding Waldo because it's a really tiny company. Yet, unless you actually know where to look, you will never see it. Well, the biggest gainer would be none other than this company over here, NVR. Never heard of it before. It's called NVR Inc. Gaining, I kid you not, biggest gainer right here for this whole entire sector, gaining 0.25%. That's it. Everything else lost a significant amount, guys. And the worst loser, like the biggest loser overall in this sector, was none other than the company, I kid you not, Domino's Pizza. I just made a video on this company today as if I'm recording this video on Friday. And yeah, if you guys do see the stock analysis on that one, well, I'm actually getting a sub 200 kind of price, mainly because they have a ton of debt. So if you guys haven't seen that video, make sure to check it out. But essentially, Domino's Pizza was the biggest loser. And when it comes to the consumer discretionary ETF sector, XLY, it lost 3.07%. Coming now into the consumer defensives, actually one of the most greenest sector over here, and by the looks of it, the biggest gainer would be the company General Mills GIS gaining 7.36%, and the biggest loser would be none other than Dollar General losing 6.37%. And when it comes to the ETF, the consumer staples XLP, on the 5-day guys, it lost 0.72%. Coming now into the financials, as Boy said that, mortgage applications really did swing the market, and that came as a surprise. And, well, not a surprise that, that's going to affect also the financial sector a significant amount, seeing that, banks are usually the ones that give out mortgages, right? So the biggest gainers here is actually a few companies gained, but the biggest gainer overall would be the company ACGL gaining 3.08%, and the biggest loser, from what it's looking like, guys, it is the company Signature Bank losing 10.09%. And looking at the ETF XLF, on the 5-day, guys, the financial sector was down 1.12%. Looking now into the healthcare sector, a lot of red here too, though kind of surprising that we did get a lot of, well, we actually got a few green ones here when it comes to the drug manufacturers, but nonetheless, the biggest gainer would be none other than this company all the way down here called GEHC, gaining 5.78%, and the biggest loser, guys, was none other than Moderna, losing 19.2% on the week. Absolute insanity. And when it comes to the sector XLV, on the 5 days, they were down 2.08%. Coming now into the industrials, once again, a lot of red here, and, well, we only got a few greens. The biggest green, though, would be none other than Deere & Company, gaining 3.6%, and the biggest loser would be this company over here called NDSN Nordson Corporation, losing 9.14%. And the ETF sector XLI overall on the 5-day lost 1.86%. Looking now into the REITs, guys, everything here was blood red. There's one company that gained, and that was none other than EXR, which gained 1.23%. And the biggest loser would be none other than this company called CSGP, CoStar Group, losing 9.53%. In regards to the whole entire sector, ETF XLRE, well, the real estate sector, guys, lost around 3.03% on the 5-day. Into the utility sector, the most defensive sector of all, we did lose a lot, but again, it wasn't really that much overall, like in comparison to the other ones that we have seen. The biggest gainer when it comes to this one, guys, would be the company EIX, Edison International, gaining 2.10%, and the biggest loser would be none other than CEG, losing 7.43%. Overall, the utility sector ETF XLU lost 1.65% on the 5-day. And now into the most meme-worthy and my favorite sector to always take a look at, guys. It is none other than the energy sector. It is blood red. Only, I believe, 3 companies were positive. We got over here FANG gaining 0.44, CTRA gaining 3.86, and the biggest gainer was none other than EQT gaining 9.11%. And the biggest loser overall, guys, would be none other than PXD, losing 9.15%, Pioneer National Resources. And of course, the ETF wasn't even that bad. Like the whole entire sector, even though it did lose a significant amount, overall on the week, guys, it only lost 0.21%. Very, very surprising. And now lastly, for the basic materials, we only got one massively green one here, guys, and that is none other than LIN gaining 7.47%, and the biggest loser from what it's looking like would be ALB losing 12.64%. And overall, the materials sector on the 5 days, XLB actually gained. This was the only one that gained 0.48%. Overall, you guys can see it right here. Like, this is just a bloodbath, absolute bloodbath. It's almost like we just did a complete reversal, as opposed to, like, I believe 2 weeks ago this thing was all green. I believe it was either last week or 2 weeks ago this thing was all green. Complete and utter reversal. And I personally think that, based off of a lot of metrics, GDP to stock market ratio, I'm still saying that we are overvalued. And then in my stock analysis, I do think that some company, actually not some, most companies are still very, very much overvalued. So seeing this much red, it kind of justifies my opinion. So that pretty much does it for this section of the video. So I'm going to leave the rest to Boy.
All right, ladies and gentlemen, today we're going to look at the S&P 500 first, and then we're going to go into the NASDAQ. So if we look on the daily chart here, we broke below key levels. So we had a fight the whole week. As you can see, the start of the week, you had a 2% sell-off, broke below the 50 weekly EMA, and then we did find buyers where we expected to find them. We found them basically at this level. We reclaimed it for a moment, then lost it again, and there was a lot of fighting around this level. So there is a healthy push and pull coming in the market where the bulls are defending levels, the bears are defending levels, the bulls are trying to gain ground, bulls going back and forth. So once we regained this level here, I did say in the midweek update, I think the bulls are being given rope to hang themselves. I think that they were expecting PC to come in to save them from their position, because you had them buying every single dip in this location up here. You didn't have any opportunity that was missed. We sold off, pushed up, sold off, pushed down, bought back up, right, especially right here. We had pushed up, then lost it, pushed back up, lost it again, pushed back up. You bought every opportunity that could be bought. You then dipped down for the inverted hammer, bought it all the way back, and then got sold back off. So all these things that I was seeing, I'm like, there is a tremendous amount of buying in this area. And if we just look at the volume, how much green volume of buying there was in this area, it is massive. We're talking absolute crazy. I remember seeing an article of $1.5 billion per day going into the stock market by retail traders, not machines. It's usually people that are investing in the stock market, like myself and you guys, that we are classified as retail traders because we don't trade in dark pool. Where we were seeing this with this volume, I was like, personally, I was thinking this was absolutely insane, because you're relying on a narrative that the second it breaks is going to be very painful. And kind of case in point, well, I was calling for a bigger short squeeze here because I was honestly thinking that the bulls had so much hopium in them that they actually could push up higher, squeeze out the shorts, because the shorts were positioning pretty heavily to the downside. However, I was wrong. I admitted I was wrong in the midweek update. Once we saw this candle, I exited my bullish positions, flipped bearish. Very profitable this week on that. On the flip, I closed out my S&P and NASDAQ position today out of the money, so full expiry $0 on that. Made about 100 there, and then closed out next week's positions just because they were 80% in the profit. So I'm right now holding 2 and 3 week out positions just so I have enough time, and I bought them around this area right here, so they're 420 expirations on SPY, so nice far out crazy number for towards the end of the month. And now seeing how PCE came in at, I'm pretty confident in that we're not going to be able to push all the way back up to 420 or even 417. I think this was the top on the market. However, I'm willing to be wrong. But I always preach this. Let's take a look at the weekly and see what the weekly. We have a failed breakout twice in 2 weeks. So this was your two levels that we were following, and you had two inside candles. So it's basically a coil winding up to break to the downside or to the upside. We broke down, we gapped down this week, and basically failed to reclaim the lows of the previous week here. Came up to the lows of the previous week and just kept selling off. Lost the 50, and now we've lost our 50-day moving average on the S&P. That's very bearish that we lost today. We bounced off it on Thursday, which was our long-term uptrend. This is our uptrend coming back from our October low to the consolidation back in January, into December into January, and then going up. We haven't retested it, and what was really surprising is that you lost this uptrend with key levels of support. You had your 50, you had your 50 again on the day and the weekly. You actually came close to touching your 200-day moving average, because if you broke that, there is little to nothing holding you up here. You pretty much have a nice, once you break that to support level, I'm going to say a nice 2.5%, even possibly 4% to go to the downside. And you have a lot of resistances now. You have to get above the 50 daily, the 50 weekly. You have to get above these levels and now are no longer support where you basically broke through. And the bears are going to defend these levels with volume like we're seeing. We're seeing increasing volume to the as we're selling off. We need to see a decrease in this volume to show reversal signs. You've lost this key uptrend, and I'm kind of seeing the same thing here, that the bears are giving the bulls enough rope to hang themselves. If we look at the 30-minute here, what happened? So you slam it down and then to the 200. This is where we're expecting to find buyers. If we didn't bounce here, I would have been very, very, very surprised, and I would actually be very cautious in any short position, because then I'd be looking for a trap. Bounced off here, good. Came back up to our upward trend, rejected off of it once, came back down, made a higher low, and then made a higher high here, however, rejecting off the trend again and our 50 daily moving average. So now you're double rejecting off this area. So now the bulls had to defend this area. They made a higher low from the previous bottom here. But if you look at a larger time frame, if we go to the 4-hour, what is the market doing? The market is making lower highs and lower lows. So you took out this low, and now you've almost taken out this low here. We're actually creating an equilibrium point here. You're making lower highs, 1, 2, 3, and now possibly 4. So is this trend going to continue? To me, it's a pretty simple thing. You basically have to break this downward trend right here to start looking more bullish. Until you break that line, you're basically going down lower. You have the potential for the bears on Monday to slam this right down to the 200. And if you lose that 200, it is a waterfall down. What are going to be the key levels for next week? So let's dive into that for the S&P. I'm going to use the weekly, and anyone can do this. It's very simple. Whenever you have a weekly candle, we have to defend the lows. So the low is going to be supported on 393.73 on the S&P. This actually goes back to on the daily. If you look here, our January 9th high where we pushed up, rejected them before pushing up higher. This was a previous resistance, became support, and now a support again. So that's a key area before the 200. So we're also going to be, this 200 is going to be probably coinciding with that area. So if we break that, we're probably breaking the 200. What is going to be our resistance point? First resistance is going to be your 50 daily moving average. Next is going to be 50 weekly moving average. And to break this trend, you have to make a higher high. You have to make a weekly higher high. So where does that come in at? It comes in at 404.29. We're going to mark that as red for resistance. And what's going to be the key level for me? To me, it's going to be, I'm going to have it constantly moving here. It's going to be the 400 level for the 50 weekly moving average. That's going to be my key level for next week, that I want to see us get above this 50 weekly to be bullish. Don't be faked out by a push up just to get rejected. You need to, one, break your downtrend. You have to have at least be above the 400 level to be bullish, I would say, because that is now being reclaimed key support for the bulls. Can they do it? I really don't know, because the daily is telling me indecision. You have a lot of indecision candles here, which is leading me to believe that we need to take a look at the futures market to understand what is actually happening here. So we're going to go to ES, which is the futures market for the S&P. And this can give maybe a clear picture because it trades 23 hours a day. We came to our 50 and then we lost it. We came to our 50 daily. We bounced off of it, bounced off, shredded through it again, but bounced off, and actually bounced off the 200. And today we went through two supports. This is why I'm saying it's very bearish. We closed below the 50 daily and the 200 daily on the S&P futures. So that's why I'm saying I'm seeing more downside possibly on the week for the S&P futures. You made not only 1, 2, 3, 4 weekly lower lows. You've broken 4 lows previously, and you're having a solid candle on the week, signifying that we could just be the start of the sell-off. Some of the people that I follow that talk about this area here of dojis, 2 dojis, usually means a reversal pattern or 50% of the move. So if we were to assume that this is 50% of the move and it's almost like a flag pattern, that would put the ES, which is the futures, 3,850. Now for those that trade SPY, that basically would put you back down at 380, 385 region, which is back to our January supports. That's where I would see the S&P kind of forming a bottom, because you would have a lot of selling pressure. You're going to want to have those shorts close out, and it really depends on if we break this key level of the 200 daily moving average. You break that, the next support probably is 387. After that, I would be seeing probably coming to retest 375, 380, around there. That's where I'd be looking. So definitely we need to be looking more bearish skewed next week because of the week we just had. And ask yourself this: what is going to cause the bears to get disenfranchised, and what is going to cause the bulls to be excited to buy this market? They're not buying this market because they want to. They're buying it because they have to. Because guess what happens once you crack this 200? All the algorithms start selling like no tomorrow, because they just see, okay, below key level and sell. So let's take a look at NASDAQ, see what it's painting for us. So we bounced off our 200 daily moving average on the NASDAQ. We closed below support from the previous week. So we're going to delete that line and the resistance line. We're going to go to the weekly to see what it's telling us. So we kind of have almost like a doji candle, but it's not really a doji candle. You have a lower low on the week. You haven't actually made a lower low on the candle here. However, so that's going to be your key support that I'm going to be talking about. So we're going to go there. That's going to be our support level. I want, if that low breaks that we made back in the end of January, it's definitely going to signify more downside. And then our resistance is going to be the peak here for the week. So we have to break this range. Now, one of the things that I want to take a look at is the month. The month closes every month. The monthly candle is made up of 30 daily candles or 4 weekly candles. And we get the close on Tuesday and Wednesday. This is my problem with the monthly candle. This is a hanging man candle or a gravestone doji. If we push down Monday and Tuesday to the bottom of this will form a gravestone doji, and it will basically cement the week, in my opinion, to be a very bearish week. We're going to basically a strong reversal, having sellers come in, sell off the entire area and hold that level. So the bears, all they have to do is hold. That's all they have to do. The same with the S&P. You're having a inside candle on the body, but then you waking up, so it's going to be a hanging man candle on the monthly, and that closes on Tuesday on close. So if we form this, we're going to need another month to confirm that it's invalidated. And usually these things don't get invalidated. So that's why I'm saying you have to be more bearish skewed than bullish skewed on the market. You broke below your 50 weekly on NASDAQ. You're slightly above the 200-day moving average, but you only got about roughly from close to there, 0.5%. Guys, the NASDAQ moves like 1% by Jerome Powell sneezing. Like, you really think that 0.5% is all that's holding you from a mass sell-off? And there's not a lot of price action here. So this area is going to be a very easy move for NASDAQ. We're going to move lower, and then you're coming back to your only support before we start really waterfalling. And that's going to be your 50 daily and 200 weekly. You guys know my opinion about the 200 weekly. That's going to be the two areas that you do not cross. That's an area, it's the line in the sand before you go absolutely bearish on something. So key level for NASDAQ next week, 290.12 or 289.89. That's the level I would use just because it's your weekly lower low. And the week high resistance is going to be the 297, 298 region. Actual top resistance, 298.73. So let's take a look at what news catalyst we can have to go lower or higher for next week. So Monday, February 27th, we have core durable good orders along with pending home sales. So this could tell us if the economy is expanding or contracting. We have to see how this news is taken. I'm not really going to be sure if it's going to be good news is good news, bad news is bad news, but I think anything that's showing a contraction in the economy combined with the PCE is going to be bad news. I think you need to see this number come in better than expected to be bullish. And then Tuesday, we have home price index, nothing really, red book, and Chicago PMI could move the market along with consumer confidence. If we see that consumers have a strong confidence in the economy, it could lend to the bullish case because it's then maybe the soft landing narrative is still left intact. If consumer confidence is falling, but you're increasing pricing, that's really, really bearish because that means inflation is almost running out of control. Similar to a lot of people will take the statement that Jamie Dimon made this week, which was the soft landing scenario is still there. There's not going to be a recession. Everyone latched onto that, but he actually said in the same interview that the Fed has lost control of inflation. His own words, the Fed has lost control of inflation. That is very powerful because the data is actually showing that. The data showing the Fed is believing their own lie. They're believing that they've conquered inflation, and inflation saying, hello, anyone home? I'm still alive. So this could be a market mover, and we have to see how it plays out. But I think my opinion about the market is already on a predetermined path. It just chooses what headline it wants to run on. Wednesday, we really don't have much. We have ISM manufacturing employment and PMI that could move the market. However, Thursday, we have continuous jobless claims 4-week average, non-farm productivity, GDP, not really a market mover, and then initial jobless claims like always. And look, guys, they moved down from 200,000 to 197,000 estimate. It's probably going to be 180 if knowing our luck with this number. Probably going to be a bearish reading there for the market on Thursday. But at that point, I feel that everything's going to kind of be settled. And then Friday, we have services PMI, ISM non-manufacturing employment. And so this is going to prelude into the following week, which we get the ADP non-farm payrolls. Quickly, I want to review the two inverse pieces to the market, which is the VIX. So the VIX on the day formed a hanging man candle, but because the market initially spiked up and came back down, you're naturally going to have people not wanting to hold above this. And VIX is actually tackling its 200 weekly moving average, which is very, very, very bearish for the market. If VIX starts getting above the 23 region, oh boy, watch out market. Here it comes. So that's why I'm saying VIX isn't dying like it should be if the market's going to trend back up. We have to see how Monday opens, but we need to keep an eye on the VIX because if it starts breaking out, it's going to come for the market with a vengeance. We have the dollar. This is what scares me to the downside for the market. What did the market do back in January? Pump, flag, pump, flag, pump. So that's what I'm saying. Monday, we could see the dollar consolidate, digest this 50 weekly moving average. And if the dollar gets above 105.40, then our next target is 106.469, which is our 200 daily moving average. And then once we start reclaiming this area, there's not a lot of price action to stop us from possibly going up into the 113, 114 region. At that point, the market is basically going to be in a tailspin. I do believe that we're going to reclaim this area on the dollar. We're going to digest it. So you may see some movement sideways for a little bit in the market as the dollar digests this region. If we break through this region with force, I'm going to be very, very short heavy into the market because the dollar is going to be at an absolute tear. Next, let's take a look at what yields we're doing, specifically the 1 year. So we're still in our bullish uptrend line here. 2-year yield, we're basically continuing the flag and just pushing up, and it's on an absolute tear today. The 2-year was up 2.51% on a percentage basis of the percentage, but as you can see here, it was on an absolute tear today. The 5-year tearing up, 10-year bullish engulfing candle, 30-year bullish engulfing candle, and then TLT, which is the bond market, basically consolidating in this region, could be forming a flag with a bear flag here, which would put TLT going down lower, bearish for the market. So there's all these things that we have to pay attention to next week, that it's very easy to follow the trend of what it's shaping out to be. You have a bearish trend until we break On the S&P in my level, it will be the 50-day moving average to show that you're trying to reverse the trend, which is 396.86 on S&P. And then with the NASDAQ, I would say with the Qs coming and closing above 295. That's the region I would say, which was our previous topping area back in November and December, and strong support or consolidation in this region previously. That could indicate a trend reversal, but until we get there, I see more downside, and I see a lot more potential to the downside. So we got to remember, pay attention to the dollar, pay attention to the yields and those key levels on the NASDAQ and the S&P. And just we're going to quickly run through the big hitters. Apple starting to fill this gap here below the 200 daily moving average. We're probably coming back to this 50 weekly retest, and Apple being such a big weighting in the S&P is probably going to pull it down. Microsoft, we're below the 200, probably going to crash land on this 50 daily, and I don't believe it's going to be strong support. I think we have a lot more downside on Microsoft. Amazon below the 50 daily moving average, and guess what? All our moving averages are pretty much up here, so there's nothing. There's just a pit of darkness down here, and once you start breaking $90.96 on Amazon, you got gaps that you're going to start filling all the way down to $86.13. However, you're going to have bounces on the way, but this is bearish. You're in a bearish downtrend, and there's not where are you going to bounce here to reverse. The low point here is $91.38, but that's on a previous bounce. That's not strong support, guys. So with all that combined, you have Google on top of it. Google looks like it wants to retest the $86 region or come back to its lows down here. It's just in a strong downward trend, and it's just chugging along down. So where are we going to find support on these big companies that's going to help the S&P get back above this trend line? You got to clear this trend line here that you now have broken. The trend is no longer your friend. Now it's your enemy. So the trend right now is to the downside. Again, when looking at this, ask yourself what is going to cause the market to go up and be receptive to significantly more downside and mitigate risk against it. So now we're going to dive into our discussion of the market, kind of reviewing the summary of economic projections first. I want to pull that up so we can talk to what the Fed may be looking at now, using their data to speak to it based on the most recent data we've got.
All right, guys. So now let's actually give our last kind of consensus when it comes to the market, specifically the next upcoming weeks. So when it comes to me, well, looking at this from a fundamental perspective, it's just, as I said, we have a lot of indicators that are still saying that the market is overpriced. And again, I have done several videos already, and even recent ones, like for example, Domino's Pizza. If you guys would like to check that out, make sure to check it out, where I'm saying that Domino's Pizza should fall to like at my highest projection, it was $160. And the current share price now is like $294. So it needs to fall. Now, that's just from me, from a fundamental perspective. I just personally think that companies do need to fall. And you just heard from Boy, essentially, like all of this crazy technical stuff that says pretty much the same thing, right, Boy?
Yeah, there was a comment this week, and it's if you don't understand something, and we're going to be trying to work to create a series for people that don't understand technical analysis, are new to it.
Yes, please,
and
please do that. Yes,
and literally, it's technical analysis is not hard. It's people choose to make it hard because they overcomplicate it, and we're going to be talking about that. But pick, if you're like, my advice to anyone that will be getting into technical analysis, pick 2 indicators and understand every indicator is based on 2 things. Every indicator is based on 2 things. There's nothing that makes them special. It's price and volume. If you can understand bare price and volume without indicators, you're significantly going to go farther in technical analysis than anyone that doesn't understand that.
So the problem with that is that, like, how do you determine that? Because, like, at least for me, like, I understand like the whole concept of volume. The volume is essentially the fuel that drives prices. But it's like, how do you know how much is too little? How do you know how much is too much?
So, for
right,
example,
that's kind of the thing.
So I can explain it real quick. So if you have any move in the market, so a trend, right? So you have to establish a trend. You're going up, you're going down. You want to see volume increasing as you keep going with the trend. That's why I was saying on the market that, for example, right here, real quick, on the S&P, we have a downtrend with increasing volume. This is confirming the move. I need to see for a reversal, which is classic, is volume starts to die down and we're still in this trend. So we need to
Selling volume starts to die down.
Yeah, so it actually can be, because volumes can be representative as a whole, and some indicators split buying and selling volume for you. But if we're just talking total volume on the market, the trend will start having volume kind of do this, where it's going to be stair stepping down, but you're still going to be trending in that direction. Then you can be looking for a reversal. Like, why I don't believe this is a reversal is because I have 1, 2, 3, 4 increasing volume candles. So now I have a downtrend, increasing volume. I'm expecting to see continuation of it based on the volume. Now, catalyst events are where is the caveat to that, aka earnings, PCE, CPI.
Yeah.
Basically,
Fed meeting minutes.
Yeah, like if you watch anyone,
Powell decides to just talk out of nowhere for some reason.
Yeah. So you see any event that is I'm going to say unforeseen. Any event that generates a lot of volatility, and you'll see this from many people on the market talking. It takes their entire thesis and says, put into shredder and shred. It takes your entire thesis, throws it out the window. That's why we always preach about during PCE, CPI, don't have positions that you have large exposure to that event. You can have positions, but manage them.
Or if you're looking at this from a fundamental perspective, don't have positions that you're not 20 years to hold them, right?
Yeah.
Like if you're gonna hold a position for 20 years, you don't really care what in the world the Fed says, or if you have like a bad quarter or whatever.
Yeah. One of
From
the
a fundamental perspective, mainly.
One of the fastest way people go bankrupt in this market with options, like the number one reason, is playing 1 or 2 day expiration or 0DT, which is the new craze. For all those that don't know what 0DT is, it's 0 days to expiration. They buy an option that's going to be worthless at the end of the day and basically hoping to get in the money. So having the direction move in your favor significantly.
That is super risky. Oh my god! That you can only do that though on the indices though, right? Like SPY, Dow, and Nasdaq.
Correct. Now because you have 0 day expiration every single day.
That's insane.
So it actually created what was called Volmageddon. If anyone wants to look that up. Long story short, you had margin debt built up on 0DT options to where liquidity completely dried up in the option chains, and you were margin calls left and right because you had so much leverage that was going insane that, like, for example, the position move because you're on leverage and now you're at a 50% loss. Your broker saying, hey, you have 2 hours to post 50% of the losses or we're selling your position and taking all your money. And then it would swing back the other way, and then they would call the other person, and this person's still thinking they're at a loss. So you see how the domino effect really started horrendously then. And the only way to play options is to have time on your side. You want to play longer term options because then you have the time and you're buying further out of the money. So you're increasing your probability to react to that, because if you see a stock moving in your general direction, yes, you're not going to get the profit margin that you're getting from 0DTE, because you can triple your account in a day with 0DTE. You also can blow your account up completely with 0DTE. So it's really meant as a tool for people that are day trading, that are very quick in and out of the market, not trying to buy and hold. Before we digress more into options, basic thing about technical analysis: volume confirms price. If price is going in a direction, volume is increasing, it's confirming that move. That's why I always say with companies that have fallen so far below their 200 weekly moving averages, that volume just dries up. So you're drying up liquidity, and you're then not able to do anything with it, and you just see these one directional movements because there's no volume to counteract it the other way. That's why we always preach about invest in SPY, invest in NASDAQ if you don't know anything, because, or like you said, over a 20-year span, they give you returns. You can buy and hold them.
I wouldn't even say if you don't know anything, just like, it's like if you want the least amount of risk. Well, honestly, if you want the least amount of risk, just put in bonds. But if you want the least amount of risk, yeah, with that 5% on this, with that 5% on the freaking 6-month bond, that's insane. Which, by the way, guys, if you guys don't know, the bond market, I believe the 6 months and the 1 year, yeah, right there, the 6 months and the 1 year has a 5+% yield. That means that bond prices have just been completely collapsing. The fact that yields are going up that much, this was about like in the morning. I don't know if the yields have come down now, but the fact that yields are that high on the 6 months and the 1 year, yeah, bonds are collapsing hard, guys. Bonds are really collapsing hard. What is this that you have over here?
The 1 year. So the
1 year. Okay.
Yeah. So basically, 1 year and the 6 year, 1 year and 6 months are trading almost at the exact same rate, and I'm curious what the yield curve inversion looks like. We always look at that.
Let me tell you right now. Bloomberg.
We made a new all-time high on yield curve inversion.
Oh yeah.
Yep, 8.73. We're either at where we were. Nope, sorry. We are 0.002% higher than we were before, and we're pretty much heading more. So this is going to get to 1%. The day that we may actually hit by March 1% inversion.
So I just pulled up Bloomberg's United States rates and bonds. The 6 month right now, as of 4:59 p.m. today, it is 5.09%, and the 1 year it is 4.99%. In comparison, guys, the 30 year, which by the way has to have the highest yield because it's the longest maturity, 3.93%, less than 4%. And the 6 month and the 12 months are essentially above 5%, if not at 5%, which is just absolutely insane. So bonds are collapsing, yields are going higher, which does explain. And also you have like PCE coming in, you have inflation kind of rearing back its ugly head. I don't know which way we're going. You know, things could turn around rather quickly because, you know, this market's just absolutely insane. But from a fundamental perspective, you know, I've been saying it from the very, very beginning. This kind of market just needs to fall. And the fact that technicals are also kind of saying that as well now. The problem with technicals, in my opinion, no offense, is just that they change on like a weekly basis, right? For fundamentals to change, it requires like years. It requires several years for me to be like, okay, now we're starting to see a downtrend on like cash flow, on net income, on revenue. Now is when we can say, okay, this is now worth something different now. But technicals, you know, they could switch in like a week or if not even a day. Am I wrong to say that?
No, technicals are for short term because a lot of people, I think they get too one-sided on the argument where they say fundamentals are important. I'm like, fundamentally, if a company's not bullish, you can throw any indicator on it. You can come up with wind yourself in this coil of trying to explain why this don't work or why it's going to go up. Try fighting fundamentals. Show me one time in history that has actually worked out.
No, you do not fight fundamentals because fundamentals are the fundamentals. So they're the foundation
like, for example,
of the companies.
For example, what you always preach about, GDP to market price. So everyone's pricing in
stock market to GDP.
Yeah, thank you. Yeah, everyone's saying stock market is going to go higher, right? Everyone's pricing and stock market go higher. The technicals and the fundamentals on bonds are basically telling you you have the world's biggest bull flag in existence, and we just broke out of it with force. And I remember a certain Fed chair. I remember Bullard saying 6% terminal rate. bonds are basically calling the Fed's bluff and saying what yields 6%. So if we get,
by the way, yeah, go on, boy.
if we get to 6% on the 2-year, holy crap, we're in deep crap. Like the 2-year is looking like it wants to rip everyone's face off right now, and if it breaks 4.883, which it only got 0.1% to do it, if this thing really rips up, we could probably be seeing the 2-year at 5% very shortly. And it's going to keep trending upwards like it chugged back up here. When this 2-year boosted off this last flag from here, because you saw push up, flag out, push up, flag out, push up, a lot of flagging, and now we're breaking up higher. So the 2-year is naturally now with this data. Let's say we keep getting this bad data, right? What if inflation goes back to 8%? Like, riddle me that. It's like, what happens if inflation goes back to 8%? This 2-year, we're going to be wishing we were back at 4%. This thing
Here's the thing though, not only 8% inflation, but you also have a lot of companies still show it, like Walmart. Walmart had pretty good earnings. So you have high inflation with a unquote strong economy, according to Jerome Powell. What is that going to do? What do you think? It's just going to give them the ammo to just be like, all right, we're just going to keep increasing rates then. That's just, that's just the way that I see it. I have pulled up right here the market cap to GDP, which, by the way, guys, this is called the Buffett indicator. I bet y'all know why. Because this is Warren Buffett, and, you do not mess with the GOAT. This is Warren Buffett's most favorite indicator when it comes to overvaluation. The average, if I'm not mistaken, the average is at around 90%. So its market cap to GDP is 90%. As of today, as of February, to be exact, February 22nd, 153.45%. 153.45%. The average is 90. The average is 90. And by the way, not even the peak. If we actually increase this to the all, we could see that the peak was, you want to give the guess, boy?
So peak, I'm guessing, was 116.
Oh, that's cute. 116? Peak? Dude, we're at 153. We're 156
I didn't
now.
hear you. 156 now. So
156 is
200?
now.
200?
198. Yeah, that was in November of 2021. So we're kind of going down, but we're kind of staircasing down. And again, the average, the mean, it is at around 90. The mean is 90. So think about that, and we're already fallen 60%. No, sorry, not 60%. We're already fallen around 50% already, and this thing still needs to fall the rest to get to the median. Most likely what's going to happen is we're going to overcorrect and it'll fall under the mean. When will this happen? I have no idea, but we're already seeing it fall. Right, we are already seeing it fall.
Yep. So. And before the stream, guys, I've been waiting to get his reaction on this because we completely forgot about this, but I just thought of it. The Fear and Greed Index, one of my favorite indicators. Would you like to guess what it's at with the current market conditions and sell-off? How tightly wound are the bulls? Mind you, 3 days ago, we were at a 64 Fear and Greed Index. So that's greedy territory with a 2% sell-off already in the mix.
So that was already on Tuesday or Monday, right?
Correct.
Actually, Tuesday, because Monday we had we didn't have. Okay, so that was, let's say Tuesday. That was a 64. I'm gonna say neutral. I'm gonna say smack dead neutral.
Show 50.
Me. Yeah.
You guys ready?
Because I have not seen this, so he's gonna get. We're still at 59. How are we still in the greed?
This is why I was saying
that makes no. Oh my God.
This is why I was saying the bears are giving the bulls rope. They are buying this dip and expecting a freight train not to run them over.
Let me just put this into perspective as well. We're in March, essentially. We're in March. 3 months ago, this thing was in fear. This thing was at around 725.
We can look at the timeline. Right? Look back in December. We bottomed at 32 fear. We're not even in
December. That was 3 months ago. My question is, what in the world changed from December to now? Fundamentally, nothing.
On a
literally nothing.
On a technical
like,
level, even that too. The market, if we look at this, right? What was this whole rally built on? Right here. What was this entire rally built on?
So that's from January, right?
Yep, January to the top.
Yeah. So so about that, I have looked into a lot of stock analysis, right, on a bunch of companies. On the 1 year, they're all down. On the year to date, they're all up. It's like as soon as January 3rd hit, boom, just spike up, because apparently, everything that happened in 2022, it no longer matters in 2023. And that's the thing too. I'm talking about this, and we're talking about this like we're bears. As we said in the last episode, guys, we are no longer bears and we're no longer bulls. We're just team money at this point.
Yep.
Whether the market goes up, whether the market goes down, at the end of the day, the purpose is just to make money. You can make money on both. Actually, you can make more money on the bear side. That's why I would like it if the market were to go down. But if it doesn't, you know what? Make my day, bulls. Make my day. I'm just going to sell puts. And if you're going to run it up, then my contracts are just going to expire. And they're going to expire out of the money. And they're going to keep your sweet, sweet premium.
Yep.
That's just that.
And
so,
also, the thing is, like, if like you looked at the market and only showed this piece, you would think you're in a bull market. But then when you show this whole thing, it's like, what are you guys up to? And you literally have this.
This might be the inflection point. This might be the inflection point where we're going to come to make lower lows.
Yeah.
Maybe. Again, maybe. We have no clue.
Yeah. And also, if this entire rally was built on absolute crap, like not everything was a lie to you, it was a complete and utter failure, you literally are going to unravel it. And if this is the 50% base point, we're coming back down to 380. If we come back down to 380, the momentum that you're going to come down here, you're probably going to build a base. But 380 I really would be surprised to see where this is at. But the thing is, PPI is a leading indicator. PPI is screaming and saying producers are paying more. Therefore, consumers are going to pay more. So if fuel is one piece that everyone focuses on, but they don't realize that the entire other 200 categories in that are bearish for the market because they're going up, it's gonna be hellish. And the thing is, everyone has this like rosy picture of a CPI, and when the expectations get printed, that's going to be the other thing. We saw today the expectations weren't printed until after they posted the result, which means that if they told you the expectation was that inflation was going to go up, the market would have tanked. So they wanted everyone to get in. They want people to buy this bottom. They keep buying this bottom so they can get out. That the thing is, big smart money is running for the door. They're not buying up here, guys. They're literally running for the door every time they see these $1.5 billion flooding into the market every day at these higher prices. They're just looking at them and saying, we can empty our balance sheet in 2 days instead of 3 weeks. Awesome. They're selling. And the thing is, again, fear and greed index. You haven't even gone to fear. You're not even at neutral. Let's actually measure this. You've moved the needle from extreme greed to greed at a 5% sell-off. So let's say you get another 5% sell-off from here to move the needle back to fear. That puts you precariously back at your 200 weekly moving average on the S&P.
We are not saying that this will happen, but it is a possibility overall.
We have to look bearish side right now because that's the trend.
That's fair, but I'm just saying in general, like, anything can happen at this point, right?
You could rip up in short squeeze. You could,
as you said, Powell sneezes and the market moves like 3%, which is just ridiculous to me. But
if you take the summation of everything you're seeing here, you have to the guidance that I'm gonna be using in the market is something is fundamentally calling a BS on the other. And
I've been calling that for like about a year and a half now.
No, but the fear and greed index is not acting rationally. Like, this should be down at 25, like me and you were saying, or at neutral at least. So there is something holding this thing up, and when it rips back down, there's a phrase that Warren Buffett says, our favorite person in the world: the greedy become the needy. So the greedy people that are trying to buy this market here, buying here near key supports, can become the needy because they want this 420 rip. They want this all-time new highs and everything. Not realizing they have a mass downtrend. They're not defending key supports. They're going to get crushed. And the problem that bulls have is they don't sell. They buy up here and then they sell down when you make a new low off of the October. That's when they're going to be capitulating out. And that's when all the smart money is going to be running in. Is it going to happen this year? I do believe this low is going to get taken out this year. That's just my opinion. But how we get there, who knows? You could have some craziness happen. You could have Russia start war with Ukraine on a massive scale and the market just goes straight to elevator down to 330 level in 2 days and hurt circuit breakers. Or you could spend the next 3 months seeing inflation go up and the market just get destroyed by the Federal Reserve. Or you could see Powell come out and say, hey, inflation's not that bad. Now, where I disagree with that statement of him making that would be, it'd be like the transitory lie that their egos are a little hurt from that. And secondly, which leads perfectly into this, if we look at the summary of economic projections, link down in the description below, guys, of this. It's a very good resource. This is what the Federal Reserve is looking at. What are we saying for start of 2022 targets for core PCE? And that was the end of the year, 4.7 to 4.8. They saw their September projections coming down to 4.4 to 4.6. Basically, you're above that now. So you're not hitting that metric. PCE inflation, 5.6 to 5.8. We just got 5.6. So we're basically at this level, and they're expecting to come down into the 3s. So by September. And it's not heading in the right direction. Unemployment's not hitting their targets. Real GDP is above their targets, which incentivizes them to push front load rate hikes, which basically means that this federal funds rate has the very large possibility to be higher than 5.4% when that market reprices that, which we will get our summary of economic projections in the March meeting that's coming up in, I believe, 3 or 4 weeks, March 22nd. So there we will get this revision. And if we get this revision with a higher federal funds terminal rate, oh boy, watch out market, new lows incoming. But until we get that, it's really up to everyone's imagination of what this could be.
So pretty much wrapping it up. Overall, the market might continue lower. Maybe. We'll see. Obviously, if you guys are in this for a fundamental perspective and on a 20 or 30 year perspective, this does not apply to you. Obviously, if you're in this for the short term, like a trading kind of perspective, then may want to consider some safety nets here and there. But that's pretty much my thought about this. Final thoughts on this, boy?
Make sure you have stop losses in place. Don't over position size risk, and have a plan when you take a trade. Don't just take a trade because some random person on YouTube is telling you to do this, do that. Do your own due diligence. Have a entry, exit, what happens if it goes wrong plan, where am I actually exiting to take profits. That's the biggest mistake people make, is they don't know when they're going to take profits, then they don't know when they're going to exit. So I would
also argue that they take profits and then they see it go up even more, and then they get FOMO, and then they get in, and then they lose. So that you also do not want to do that as well. But anyways, guys, that will pretty much do it for this video. Kind of long. Hopefully we'll cut this down up a bit. But that pretty much does it for this one. Liked if you like, comment, subscribe. It really does help with the algorithm on YouTube. You guys can follow us on the new tech sites. Link in the description below. So with that said, peace out, and we'll see you all next time. Any last words, boy?
Nope, just trade smart.
And of course, make money.